How should you structure the ownership and control of the founders of the company? More plainly stated, how should you divide up the ownership interest in the company? Well, this is a question that's going to be unique to every startup, but generally it's based on a combination of two things: timing and value. When did the founder join the company? Were they the original ideator, the person who assembled the processes and brought the business into existence? Were they simply an early employee who really brought the business into its current form? These early founders are obviously going to receive a larger ownership interest because generally they're working in the beginning for no money. They're working for their ownership interest to establish the business. And as the business becomes established and begins to bring in revenue, additional employees may be added, and those employees may be granted lots of ownership interest and become even majority owners someday. But again, that's a determination based upon the second factor, which is value added. So early on in that process, when you're dealing with founders, whether it's the original founders or early employees who are considered founders, if you will, there are numerous factors to determine what type of value they're bringing. Number one, are they bringing in any form of intellectual property, like work already completed, trademarked work, patented work, copyrighted work, that type of thing that has a ton of value already, because that can be used to bring in and fund the business and get it rolling. Okay. Another is their work product. What responsibilities will the founder have? If the responsibilities of one founder is far more valuable than the responsibilities of another founder, then it is logical to give a larger ownership interest to the more valuable founder. But it may be even that the more valuable founder is doing less in terms of actually building the business or has less industry knowledge and things like that. Oftentimes early on, a very influential member is the technologist, but the technologist may have very little interest in actually running the business. They're more focused on developing the product that's going to be sold. In that scenario, they're adding a ton of value, but the nature of their responsibilities means that they're probably not going to get much larger ownership interest than the founders who are working on building the business. So, and then there's other factors that have different types of value, such as industry knowledge or industry connections, celebrity status, things like that, that can add a ton of value to the business, but don't require as much time and effort in terms of work product or responsibility. So those are the primary factors that go into it. One question to ask is, what are the expectations of the founders from the very beginning? How do they see their roles in the company? What is their long-term objectives for being in the business? Because this will make a determination as to whether they're more suited to receive compensation in the form of a salary from the revenue, or whether it's better to have a larger ownership interest and a smaller percentage of whatever profits or revenue that's generated from the business, that sort of thing. And one issue that's always lurking for founders is the idea of dilution. So oftentimes, the early founders will receive common stock or some form of founder stock. That's a special version of common stock that has some preferred characteristics. And then later, when additional employees come in or investors invest in the business, they'll receive a different type of equity, often a preferred stock that gives some kind of preferred advantages, such as a liquidation preference or some other redemption rights or voting rights or dedicated board seat or something of that nature, right? But nonetheless, it still dilutes the ownership of the existing founders, because say you have 100 outstanding shares and you issue 100 new preferred shares to give to new investors or employees or something like that, then all of a sudden now you have a total ownership pool of 200 shares. So the value of your 100 shares as founders is half as valuable. And oftentimes these later preferred shareholders will have anti-dilution provisions or protections that keeps their stock ownership from being diluted with future distributions of equity. So it means that the founders have an outsized reduction in ownership interest every time you issue new ownership interest compared to those who have dilution protection. So that's a major consideration. So if you have founders that are primarily focused on owning the company, it's not about bringing in a salary immediately. They expect to be in the company long term. Any value that they receive will be upon sale of an ownership interest in the business. They're probably going to be more concerned about dilution issues and want to hang on to a larger ownership percentage than perhaps some other individuals working in the business who realize they may not work in the business long term, that they may be better suited again to receive perhaps a contractual right to revenue or a profits interest rather than an actual ownership interest in the company. So you look at the expectations and what you hope to achieve and where you hope to be, your vision in the future of the company, and those are the factors you are going to consider when sitting around the table and divvying up the ownership interest among the founders of the business.